Section 3, Primary and Secondary Bond Markets. Primary bond markets are markets in which issuers first sell bonds to investors to raise capital. Bonds can be sold or issued, these terms are used interchangeably, via a public offering or a private placement. Secondary markets are markets in which existing bonds are subsequently traded among investors. Let us first talk about primary bond markets. Public bond issuing mechanisms include underwritten offerings, best effort offerings, shelf registrations, and auctions. Notice that we are first talking about public bond issuing mechanisms. There will be a small segment on private placement later. Let's talk about each of these now in a little more detail, starting with underwritten offering. Here, the investment bank buys the entire issue and takes the risk of selling it to investors. So just to understand what's going on, we have an issuer. This issuer might be a company like General Electric, which wants to issue bonds. It will issue bonds through the help of an investment bank. So let's say the investment bank is Goldman Sachs. So the investment bank will help raise money through the issuance of bonds. With an underwritten offering, the investment bank effectively buys the bonds from General Electric at a certain price, and then the investment bank is responsible for selling those bonds to investors. Effectively, the investment bank has taken the risk. If the investment bank can sell the bonds to investors at a relatively high price, then the investment bank makes money. If it cannot, then the investment bank loses money. So you can see that the risk has been transferred from General Electric to Goldman Sachs. At a high level, here is the process. The first step is for the issuer to determine roughly how much money is needed. So that is the determination of funding needs. This is done by the issuer, maybe with the help of some advisors. Then comes the selection of the underwriter. In most cases, there will be a lead underwriter or a lead investment bank, and then a few other investment banks. This group is called a syndicate. And the offering where we have multiple investment banks involved is called a syndicated offering. The next part is the structuring and announcement of the offering, and this will involve deciding on the notional principal, deciding on the coupon rate, deciding whether this is fixed or floating. In other words, the bond is being defined. Then comes pricing, and this is extremely important because the investment bank needs to get the pricing right. And by getting the pricing right, we mean that the bond should be priced such that the supply of bonds should equal demand. If the bond is priced too high, then the issue will be undersubscribed. There will be too much supply relative to the demand. On the other hand, if the price is too low, then the demand will be very high relative to the supply. So getting this right is important. From pricing, we go to issuance, and here I will actually read a small segment from the curriculum which describes this phase very well. The pricing day is the last day when investors can commit to buy the bond issue. This is investors buying from the investment bank. So the pricing day is the last day when investors can commit to buy the bond issue, and it is also the day when the final terms of the bond issue are agreed on. The following day, called the offering day, the underwriting agreement that includes the bond issue's final terms is signed, the underwriting process enters the issuing phase. The underwriter or the syndicate purchases the entire bond issue from the issuer, delivers the proceeds, in other words, gives the money to the issuer, and starts reselling the bonds through its sales network. So the underwriter is now selling the bonds to investors. The underwriting process comes to an end about 14 days later on the closing day when the bonds are delivered to investors. That was a very high level view of the process. If you want more details, you can read the curriculum, but from a testability perspective, I think you will be fine with this level of detail. Another mechanism is a best effort offering. Here, the investment bank simply serves as a broker and sells the bond issue only if it is able to do so. Again, we have the issuer, the investment bank, and investors, but the risk here is with the issuer, because all the investment bank is saying is that it will help the issuer find the investors. If the investors are not that interested, then obviously the price is going to be low and the issuer will not be able to raise enough funds. As a general remark, these two methods, underwritten and best effort offerings, are frequently used in the issuance of corporate bonds. Another method used is called shelf registration. A shelf registration is a method for issuing securities in which the issuer files a single document with regulators that describes a range of future issuances. So the big benefit of this approach is that it reduces issuance cost. In the earlier two methods that we just talked about, best effort as well as underwritten offering, there is a substantial fee that needs to be paid every time the transaction happens. But with shelf registration, this in a sense is a continuous process where the issuer can keep raising money and the cost is only paid once. The final method we'll talk about is an auction. An auction is a public offering method that involves bidding, and that is helpful in providing price discovery and in allocating securities. It is frequently used in the issuance of sovereign bonds. I'll not talk about this here because we discussed this method in detail in economics in the context of issuing government bonds. Here now we'll talk about a private placement. A private placement is typically a non-underwritten, unregistered offering of bonds that are sold only to an investor or a small group of investors. Typical investors in privately placed bonds are large institutional investors. A private placement can be accomplished directly between the issuer and the investors or through an investment bank. Because privately placed bonds are unregistered and may be restricted securities that are only purchased by some types of investors, there is usually no active secondary market to trade them in. Now let's take a look at secondary bond markets. In the secondary market, securities are traded among investors in the secondary market. In a sense, this would be like a stock exchange, but bonds are generally traded in over-the-counter market, as we have discussed before. Secondary markets can be structured as organized exchanges or as over-the-counter markets. Most bond trading happens in over-the-counter markets. As a bond investor, it is important to understand the liquidity of a market. Simplistically put, the bid-ask spread reflects the liquidity of a market. If the bid-ask spread is wide, that means that the market is not very liquid. If the bid-ask spread is narrow, that means that the market is quite liquid. The liquidity in the bond market is provided by the market makers, and one example in the Eurobond market is the Eurobond market makers. So these market makers stand ready to buy and sell Eurobonds. As with other types of securities, settlement is the process that occurs after a trade is made. This might be on a T+1 basis, which means that settlement happens one day after the trade, or it might be T+3 in other markets. This means that settlement happens 3 days after the trade. Let's look at example 3. Which of the following best describes a primary market for bonds? Bonds are issued for the first time to raise capital. This looks right, but let's look at the other options. A market that has a specific location where trading of bonds takes place. This sounds a lot like an exchange, which would be a secondary market concept. A market in which existing bonds are traded among individuals and institutions. This is the definition of a secondary market, so not the correct answer. The best answer is A. US Treasury bonds are typically sold to the public via an auction. I mentioned that briefly here, and we've seen this in economics. In a single price bond auction, an investor who places a competitive bid and specifies a rate that is above the rate determined at an auction will most likely not receive any bonds. I know I have not covered this material here, but as I have said before, this is covered in economics. But since this question has shown up, I'll describe what's going on very briefly. To understand what's going on here, let's look at a simple example. Let's say the government is issuing or selling 1-year zero coupon bonds. The par value is 100. Investors bid for these bonds and they submit their prices or rates. And notice the prices and rates are interchangeable. Since the government is selling, obviously the government likes the investors who are paying a high price, and that high price corresponds to a low rate. Let's say that up to this price and the corresponding rate, all the bonds that the government wants to issue can be issued. In other words, up till this level, the demand and supply match. What that means is, if another investor comes in and says that they are willing to pay 90, which corresponds to this relatively high rate, then that investor will not get anything. And that's why the rate, or if a competitive bid specifies a rate that is above the rate determined by the auction, then the investor will not receive any bonds. A bond purchased in a secondary market is most likely purchased from whom? The issuer, lead underwriter, or another investor in the bond? Here the answer is C. Both 1 and A apply in the primary market. And just to make sure you understand this, in the primary market we talked about different methods. If we have a best effort offering, then the investment bank is simply a broker and the investor will buy from the issuer. In the case of an underwritten offering, the issuer sells to the underwriter and then the underwriter sells to the investor. Corporate bonds most likely settle on trade day plus 3 days. So just remember the fact. Government bonds and quasi-government bonds generally settle on trade day plus 1 or T+1. Sovereign bonds are issued by national governments primarily for fiscal reasons. Sovereign bonds have different names in different countries. In the United States, for example, they are called US Treasuries. Sovereign bonds can also have different names depending on maturity. To continue with the United States example, bonds with maturities of less than 1 year are called US T-bills or Treasury bills. When the maturity is between 1 year and 10 years, then the bonds are called Treasury notes or T-notes. And when the maturity is greater than 10 years, then they are called Treasury bonds. Another term that you need to remember is on the run. On the run securities are securities which have just been issued. These are sometimes also called benchmark issues because they serve as a benchmark against which to compare bonds that have similar features. Generally, on-the-run securities have lower yields relative to off-the-run securities. Off-the-run securities are securities which have been issued a while back. Credit quality of sovereign bonds. Sovereign bonds are usually unsecured obligations of the sovereign issuer. In other words, sovereign bonds are not backed by collateral. Instead, they are backed by the taxing authority of the federal government. When the federal government or the national government runs a budget surplus, then the excess money can be used to pay off bonds. If the country is running a deficit, then the federal government can issue new bonds and use that money to retire old bonds. Because governments have taxing authority and can also print money, generally sovereign bonds are considered to have very low credit risk. In any case, credit rating agencies such as Moody's, Fitch, and S&P do assign credit ratings to sovereign bonds, and by and large these credit ratings are very good. It should be noted though that sovereign bonds don't automatically receive the best possible AAA rating. The reason is that there is still a very small chance of countries defaulting. If a country is running a very large deficit, then it might not be able to make debt payments. So there are several countries which have ratings below AAA. Another point to note is that there will be a distinction between the credit rating of bonds in the local currency versus the credit rating of bonds in a different currency. The Indian government, for example, might issue bonds in the Indian rupee and also issue bonds in US dollars. The rating of the bonds issued in Indian rupees will generally be better than the rating of bonds issued in US dollars. Sovereign bonds can come in different flavors. The most common is a fixed rate bond where the coupon rate is fixed. Zero coupon bonds would also in a sense fall in this category. A zero coupon bond is a bond where there are no intermediate coupons. A classic example would be a 6-month zero coupon bond with a par value of 100 and the issue price might be 97. Notice that there are no coupons in between. A 20-year fixed rate bond would be one where a fixed coupon rate is paid every 6 months over a 20-year period, and then the principal amount or the par amount is returned at the end. The issue with fixed rate bonds is that they are very sensitive to interest rates. If interest rates go up, then the present value of all the future cash flows is going to come down. In other words, the price of the bond will come down. Some countries issue floating rate bonds, and we've gone over this several times. With floating rate bonds, the coupon payment is tied to some reference rate. And finally, some governments issue inflation-linked bonds. The example that we talk about the most is this: TIPS, Treasury Inflation Protection Securities. These are issued by the US government. Here the par value is linked to inflation. More specifically, it is linked to CPI. Inflation-linked bonds are also called linkers sometimes. Let's do example 4 now. Sovereign bonds with maturity at issuance shorter than 1 year are most likely, and the answer here is zero coupon bonds. This is just something you need to remember. In most countries, if the maturity is less than 1 year, then the bond doesn't pay any coupon. It is a zero coupon bond. Floating rate bonds are issued by national governments as the best way to reduce, and the answer here is interest rate risk. If you remember my example with fixed rate bonds, the problem is that a rise in interest rate will cause the price to come down a lot. But if we have a floating rate bond, then the coupon payments will go up with rising interest rates. So the price will not come down as much, which means that we have lower interest rate risk. Sovereign bonds whose coupon payments and or principal payments by a consumer price index are most likely known as linkers, and we've just talked about that.